My name is Jake. Welcome to the channel. If you clicked on this video, you're probably interested in investing into dividends. And that's what I talk about in every single video. As you can see here on my screen, this is my M1 Finance account. I'm very transparent. I share with every single person here what I'm doing, what I'm investing in, share what is working, what is not working. And in today's video, I want to talk about three things. I want to talk about compounding interest and what that means for dividend investors. And the next thing that I want to talk about 10 different companies that are beating the S&P 500. On this channel, I don't really talk a lot about, the goal of this channel is to talk about how to beat the market, but I thought it would be interesting to compare, historically, if I were to just invest into a low-fee, broad-based ETF like the S&P 500, what that would compare with if I were to just go with 10 different companies that I handpicked. All right. And so that's going to be the second thing. And then the last thing I want to go in and I want to share with everybody, some of the dividends that I've been getting paid here in the portfolio kind of show that snowball effect or that compounding effect in real life with my portfolio. So the miracle of compounding, I think a lot of people have heard this before, that compound interest is the eighth wonder of the world. It really is. It's one of those things that we don't really see it on the surface when we first get started. It's more of a long-term investment strategy. And a lot of people in today's age, we have that urge for that instant gratification. And I think a lot of younger investors have a difficult time grasping this and understanding, my investments, I don't have to buy and sell every single day. I think everybody gets consumed with day trading. And I think as a young investor, it's easy to get lured into that approach, going to Vegas, putting everything on black on the roulette table, and then winning everything, or on the reverse side, losing everything. So what does it actually mean? Like compounding interest, how does it actually look? What does it look like? So in the beginning, it really, you're not going to see a lot of upward trend in the beginning, but over time, as your investments start to compound and that snowball effect is really going to start picking up later in years to come. It's not going to be 1 or 2 years that you're going to have this snowball effect, especially if you're starting out small, which most investors do. If you're a normal investor, you have a 9-to-5 job, you're not going to have this snowball effect tomorrow. It's going to take a few years. And it could be 5 years, it could be 10 years, it could be 20 years. Right? And the thing that I love about this is it doesn't matter if you're on an annual salary of $50,000, $100,000, $200,000, whatever it may be, you can still take advantage of this snowball effect, right? I love looking at Warren Buffett as a teacher or as an example when it comes to this, because he really is that example of compounding interest. When you look at his net worth when he first started out, now I don't know a lot of 14-year-olds that, generated $5,000 on their own. So he is kind of a unicorn in that sense. He is special. And, over time, it wasn't till he reached the age of about 30 where he made his first $1 million. And it wasn't until not even 3 years later where he doubled that. And you can see that compounding effect, just that snowball effect, just rapidly take over. Okay. Now, when I think of a snowball or a snowball effect, I usually kind of think about this. I love that. I had to show that. When I was preparing the video here, I showed that to my wife and I asked her, hey, should I put this in the video? And she's like, yes, you absolutely have to put this in the video. So that's why I put that in there. You don't want to be that new dividend investor that goes after that 12% dividend yield, and then the next day the company files bankruptcy and then you lose everything. So you want to be careful, right? When I talk about on my channel investing into a dividend growth strategy, I'm really talking about investing into quality and the way that I do that is I have a few things that I focus on. I focus on historical data. We know that historical returns are no guarantee of future returns, but I think the past has a story to tell us that will help guide us, right? And we can learn from that. We don't want to solely rely on it, but we can learn from it. Now, what you can see here in front of you is the historical returns of different investments, right? SPY, this is the ETF that I'm going to be talking about throughout the video here. SPY is the largest asset under management ETF out there. It focuses on the S&P 500 index, and that is it. The other ETF here that is being displayed is Noble. Noble is a smaller ETF with only 58 holdings, but it's looking at companies that have increased their dividend over the last 25 years. So when I talk about investing into quality, this is what I'm talking about. And whenever we compare historical returns, it's very, very important to get as much data as you can. If you just look at the last 5 years, it's not going to be very conclusive because we've been in a bull market for over 10 years. And as we know, these high quality dividend growth companies, they grow at a slower pace than, for example, a Facebook or an Amazon. And if you were to compare the companies that have, the dividend aristocrats that have grown their dividend for the last 25 plus years, they're going to perform better or different in different timeframes. For example, in 2008, the broader market got destroyed, right? It was down about 37%, but also the dividend aristocrats are not immune to that. They also got hit. So the data that I'm going to share in this video is really going to be looking at the last 10 years, but I do want to highlight that this is more skewed in the favor of the hyper growth sector in Microsoft, Apple, Amazon, Facebook, and such. So I do want to highlight that. Okay, but when you're investing in a high quality dividend stocks, right, you can sleep well at night, and that's what I talk about on the channel. All right, so the next thing that I want to dive into here is I was curious to see, okay, if I were to look back in the last 10 years, and if I would have just invested into SPY versus investing in 10 other companies that have grown their dividend quicker than the broader market, what would those returns look like? And I'm really excited to share with everybody the results that I found. But before I do that, I want to share with everybody kind of a history lesson here. What has been the historical dividend growth of the S&P 500? Over the last around 30 years, it's averaged right around 6%. Right now, we're over 8%. So the market has gone up, it has gone down, but on average, it's averaged right around 6%. Okay, and in the comparison that I'm going to make here in a second, I want to make sure that everyone understands what I'm talking about. With SPY is once again the largest asset under management ETF. It's the most popular. And if you were to invest into SPY, you would get exposure to 500 companies, and that exposure would be weighted. So you'd have the most exposure to Apple through this one investment. You'd also get a lot of exposure to Microsoft. Now, what I do want to look at is, okay, yeah, you're going to get exposure to Apple and Microsoft, but what does it look like for all these other companies, right? These other companies, you're going to get much lower exposure, less than 1%, less than 0.5% in the remaining, 470 plus holdings within this ETF. So that's how these ETFs are set up. And so what I did is I took a look at 10 different companies, and every single one of these are in my portfolio. And what I did was I looked at different factors. For example, the 10-year compounded annual growth rate of the dividend. This is just the dividend, not the share price. Then what I did was I looked at the current yield. Now the current yield, it fluctuates, right? At the time that I prepared this video, this is what the yield was at. The years of consecutive dividend growth, and the payout ratio. Payout ratio is very, very important because this is kind of your risk factor. And what percentage of a company's profitability, revenue that they're bringing in, are they paying out to their shareholders in forms of a dividend instead of, for example, reinvesting, innovating, research and development. And so this is everything at a glance. These are the 10 companies that I chose here. A lot of them you're going to recognize. For example, Costco, Microsoft, Visa, Union Pacific, Lockheed Martin, and so forth. And if you average out these 10 holdings, you're going to have an average 10-year annual compounding annual growth rate, the dividend, of just over 16%. The current yield is going to be under 2%. The years of growth are going to be averaged at around just under 23 years. And the payout ratio is right around 44%. All right, now if you were to just go with SPY, this is what you would be getting with the same criteria. With the 10-year dividend growth rate, compounding annual growth rate, you'd just get under 10%. Current yield of 1.7%. Years of growth, 10%. And the payout ratio, just under 55%. So what I did was I thought, okay, if I were to invest over the last 10 years, 15 years, 20 years, or 30 years with this strategy, what would my return be? And what would that compounding effect look like? What is going to be my return? And so what I did is I went over here and I shared this in my last video, is with the dividend investment calculator, and I typed in the numbers here, the initial investment, and I have some assumptions here that I'm going to share in a second. I typed everything into here, and this is how I got the information for what I'm going to share here in just a second. So what I wanted to find out was, okay, with the following assumptions, and once again, this is not conclusive. You can't predict the future, but if we take historical returns, right, and this is no guarantee, but if we took the historical returns under these following assumptions of you're investing $10,000, you're going to reinvest the dividends, and your dividend yield is going to remain the same. Now, this is unlikely, but we're not going to be able to work with anything else. The dividend growth rate is going to remain the same. Also very similar. This is tracking the last 10 years of a bull market. This is obviously going to fluctuate on both sides. The 10 companies are going to fluctuate, but also the broader market is going to fluctuate. But I believe, coming back here, because the investments are more set up for success during a down market, I think it's actually going to be in the 10 companies' favor versus just going with the broader ETF. And the next thing is you're not going to have any additional investment, so you're not adding anything in there, which is also unlikely. I mean, on this channel we talk about growing your income, growing your passive income, and in continually automating your investments. But in this scenario, we're not going to add any additional investment, and this is also not factoring in inflation. Okay, I do have the inflation numbers, but just for the what we're going to see here, it's not factoring in inflation. So what is that going to look like? So the monthly cash flow from dividends that you would receive after 10 years of reinvesting of these dividends into these different strategies, if you went with SPY, just went with the ETF, you'd have $574 in dividends every single year. It's not bad. It's not a lot, but it's not bad. If you went with the portfolio that I built here, the 10 different companies, you'd have $1,252. All right, now let's take a look at 15 years. If you were to do this with SPY, you would have, over 15 years, you would have $1,202 every single year coming to you in dividend paychecks. If you went with M1 Finance, it'd be just under $5,000. All right, now this is where it gets really interesting. If you did this for 20 years, in the SPY ETF, if you just held on to it, reinvested the dividends, you would have just under $3,000 every single year in cash flow. All right, so in M1 Finance, you would have, now this is insane, right? You'd have just under $34,000. And if you were to do this for 30 years, if you were to invest in the SPY with the following conditions that we just talked about, you would have $44,000 in cash flow, in annual cash flow. If you were to do the same thing with M1 Finance, you would have over $276,000. This is incredible. This is pre-inflation, but this is the magic of compounding dividends, compounding interest. And that when I shared this with my wife, when preparing the video, she looked at me and she said, "Jake, are we doing this?" And I said, "Yeah, we absolutely are doing this." Alrighty, I want to dive into M1 Finance, and I want to see, okay, if I were to just go with the SPY, S&P 500, what would it look like in my M1 Finance portfolio? Right, the historical return of this is not factoring in reinvestment of dividends. You would have just over a 60% return over the last 5 years if you just went with the SPDR SPY S&P 500 ETF. You would have an expense ratio of 0.09%. You'd have a dividend yield of just under 2%. So this is what your return would look like if you just went with the SPY. Now, I mean, this is not bad. I mean, this is a great return, right? All right, if you went with the dividend growth stocks that I shared just a second ago, the 10 companies, if you had them in a pie here in M1 Finance, this would be your historical return of the last 5 years. Now, this is, once again, not factoring in the reinvestment of dividends. So just under 120%. You'd have double the return. But the crazy thing is, these companies, these are dividend growth companies, right? This is not looking at Facebook or Amazon or these other Tesla, these hyper growth companies. These are fairly conservative in some cases. We do have growth companies in there, for example, with Microsoft and Visa. But if you were to have this set up, these 10 holdings, you would have a dividend yield of 1.8. But the thing that I want to stress here is this dividend yield, this is growing, and it's growing exponentially. If we go back to our slide here, it's growing on average just over 16%. So you're going to be getting and this is also factoring in the last 10 years in a bull market. So this could fluctuate, but this is really the power of compounding interest, right? Okay, so that is it's really interesting to kind of look at and see, okay, how would this look like if I were to invest directly into SPY, or if I were to select my own holdings. Now, I believe that picking your own companies is not for everyone. I actually believe the majority of people would benefit from going and sticking with just an ETF. It would serve you better. But on my channel, I really talk about doing both, and I do both. On my channel, in my portfolio, I'm invested into individual holdings as well as dividend growth ETFs. Okay, so in my portfolio, what I want to look at today is I want to see that compounding effect in my own portfolio. And as you know, I haven't been invested into M1 Finance for that long, right? I've been invested since May of last year. I transferred over my portfolio from Robinhood into M1 Finance and have been investing into it every single week. But looking at the compounding effect in action here in my own portfolio, if we look at just the dividends in the last month, you're going to notice that some are higher than others. They're very small. I mean, I'm getting less than 30 cents in some of my holdings. I'm getting a few dollars in others. I'm getting $17, for example, in Altria Group. That also is because it has a higher dividend yield, as well as I have a higher position in Altria Group. Okay, and so these are some of the dividends that are coming in. And the thing that I love about M1 Finance, it's leveraging these dividends to purchase not only shares of the individual company that pay the dividend, but it spreads out among other holdings. Okay, and if we were to, for example, just look at Altria Group and what that looks like, this is a prime example. In July, I was paid just under $9 in dividends. In October, they increased their dividend. So yes, there was a factor of adding additional capital to it, right? With Altria Group, you can see here I transferred it over from Robinhood. I started purchasing additional fractional shares. I got paid a dividend of just under $9 in July. and I paid in more and more into the holding, and they raised their dividend. They raised their dividend, and you can see that dividend payout is growing, and it should be growing every single time as I add additional funds to the account. So that is how I have it set up. And I have that set up for my main portfolio here in my cash flow portfolio. The dividends that are being paid out, this is what I'm looking at. The market gains, yes, they're nice to see, but really what I'm looking for are those earned dividends so that I can pay for my living expenses. And I have two portfolios in my M1 Finance account. I have my main portfolio as well as I have my real estate portfolio. In my real estate portfolio, I have it set up very, very similarly. I'm looking to break it down by sector because within the REIT or real estate investment trust sectors, they're set up differently. They're impacted differently by market conditions, and so I have it set up that way. And the same with not with Altria Group here. The same with my real estate portfolio here is I'm investing into it every single week. Every single week I'm adding more and more money, and you can see that the dividends are also coming in, and they're small at first, but they're growing. Alrighty, everybody. I hope that this was helpful. Really, the message that I was trying to get across here was it doesn't matter if you have $1,000, $10,000, or $1 million. Everyone can take advantage of the miracle of compounding. And in this video, I really wanted to share what it would look like if you were to just invest into a single ETF or if you were to invest into individual holdings and what that could look like over the long term. And as we saw earlier, just having a difference of a few percentage points, a difference in yield, what kind of a massive impact that can have over the long term. I hope that this video was helpful. If you're new to the channel, I'd invite you to subscribe, like the video, and I'll catch everybody in the next video.